You know that feeling when someone shows up for you just when you need it most? That's what Uber is all about. Not just a ride or dinner at your door. It's how Uber helps you show up for the moments that matter. Because showing up can turn a tough day around or make a good one even better. Whatever it is, big or small, Uber is on the way. So you can be on yours. Uber, on our way.
Reality radio for a really great future. We're talking real money.
You know, the world still feels strange, doesn't it? It still doesn't feel quite right. I'm just wondering when it's going to feel right. I don't know. I don't like it very much, though, I got to tell you. I want normal, but we can't have normal. I understand. I'm very, very realistic about that. Hello, everyone. I'm Don McDonald over there. Mr. Thomas C. Cock, co-host of the Puget Sound renowned Talking Real Money radio show and internationally renowned Talking Real Money podcast. Thank you for joining us here on the radio show and later on the podcast. This, ladies and gentlemen, may be our best show ever. But to make it even better than our best show ever, we encourage your participation. Your questions are what makes us happy. So give us a call at 855-935-TALK, 855-935-8255. Now, speaking of this new world we live in, it's also becoming a new world for investing, and that's sort of the topic for this hour of the show or this podcast, is what's changing in the COVID/post-COVID world of investing.
Well, and this is one of the arguments I have with people a lot about investing. I think people think they put money into the stock market is like rolling the roulette wheel or rolling the dice. I mean, it's some sort of, I'm taking my chances.
Or rolling the poker chips or rolling the barrel, because we'll have a barrel of fun.
You got to step back and say, at the end of the day, what is your money really being exposed to? And what it's really being exposed to is
coronavirus.
Business. Well, there's that.
Thank
sorry.
You.
That's very kind of you.
That one.
That's why I don't use the paper anymore. But it's really being exposed to businesses. Now, businesses have had to change, and they've had to change a lot. So I happen to know one. A very small bit. And by the way, by the time you invest in the businesses that are traded on Wall Street, they've been pretty well vetted by a number of people, invested in by a lot of other people. But think about this for a minute, because I know a small business that was in the food services industry and was doing pretty well. I mean, supplying food.
May I interrupt for a second?
Yes.
Is this a question? Business? You said it was a food service business.
Well, that's
Isn't it
true.
Still one?
Yeah, it is still one. Okay.
If she's listening right now, you're going to be in trouble.
No, she's not listening because she's working.
For
I know
being
her.
the nattering nabob of negativism.
No, I mean, okay, so you already ruined my story here because I was going to do
I didn't say anything
story kind of thing. But because this business, catered to big, huge events like fairs and festivals and major corporate events and big weddings and all that, that's where the money was made. And then when all of this came along and they said you can't get together in big groups, we're going to cancel all those major events, we're not going to have the fair, et cetera, et cetera. This business, this person running that business had to rearrange the whole business. And yesterday, she reopened the business. It's now a contactless food truck. You drive up, you order online, you have your order, you park. I watched all this yesterday. They call you out, you come out of your car, you get it, you drive home. It's all done. There's no contact of any kind, and the product is still very good. There's a drone
that flies it between the.
Oh, don't
truck.
make it harder because she already spent like 200 hours to get it to this point. Okay, so the cat's out of the bag. I'm talking about my wife's business.
I didn't say anything. I didn't say your wife.
I have nothing but the highest praise for the fact that she has turned this thing 90 degrees, turned it into this contactless business. She did enough yesterday to be profitable. She's back out doing it again. Can I give a little pitch for where she is?
I was hoping you were going to give her a pitch.
All right, I don't want to get in trouble.
I see you're wearing.
I know I'm wearing the shirt to be supportive.
The polo shirt from the firm.
Yeah, the one that still fits me.
They sold a ton of pizzas yesterday.
Well, she sold 51 yesterday. You're mildly profitable at 50. So it's Pompeii wood-fired pizza. And she's at the corner of Maltby Road and York in beautiful Bothell, Washington. So you can look this all up online. You order online.
Even if you don't want pizza, drive by and yell, "Hey, Dee Dee!"
It should probably wave. Here's the point I'm trying. 2 points. Number one, I have nothing. I think it's phenomenal that she's done this. But number two, when people invest, they think again it's like a crapshoot. It may be if you do individual stocks, because her business may or may not work in the post-COVID world, but businesses will. Starbucks just announced they're opening 85% of their stores. Businesses change, they evolve, and what you're really investing in, as you pointed out, Don, is the growth of the overall economy over the long haul.
Companies come, companies go, but business goes on, and those who evolve, like Dee Dee, like Pompeii Wood-Fired Pizza, tend to do better than those that stick to their same old ways of doing things. 855-935-TALK.
Tom and Don are talking real money.
If you're sick of your self-interested financial advisor and are looking for a 100% fiduciary low-fee investment advisor, call my firm Vestory at 800-386-3004 or visit us at vestory.com.
For your real life and real future, Tom and Don are talking real money.
Once again, like to remind you that our number is 855-935-TALK, 855-935-8255. And in addition to being able to call us, we found out that you're very clever and you found our email addresses, which were not hard to figure out.
There's a hack that took a lot of time.
So we decided, why not? If you want, send in a question via email to Don, D-O-N, not D-A-W-N, the male version of it, at vestory.com or Rostov on Don.
Yeah,
I just watched that. I watched the Soviet storm about Rostov on Don, so I just went. I'm in.
I don't remember that battle.
That was the Caucasus.
Oh man, it's just brutal. Whole thing is just totally destruction at a high.
The whole war. The whole war was pretty brutal.
It was bad,
all in all. Hey, everyone. We're here to help you deal with your dough on this radio show and podcast. And please call us anytime at 855-935-TALK, 855-935-8255. But we're live on Saturdays from noon to 2 Pacific, 3 to 5 Eastern time. And the world, it is a changing. Investing is changing. Retirement is changing. Our work is changing. Everything is changing. There are changes occurring, and you need to change with the changes. Is that
a lot of change going on there? But the question at hand that comes up from time to time is, how should I invest for a post-COVID-19 world?
Yeah. So how should I invest?
I've asked you first.
I don't know. I'm so confused. No. I do know. I know.
We just did a great webinar. We had over 200 people on it earlier this week that with our friend and colleague Paul Merriman that we're talking about some of this, about bearing a bear market and what to do with your money now.
Yeah, and one of the things that is going to become and is probably very obvious to you right now is that this business of as Tom mentioned earlier, kind of playing the game of investing, those days should be over. If it isn't obvious to you now, it will never be obvious to you. We have companies, big, very successful companies, once again starting to fall by the wayside. We've had a couple of big bankruptcies announced in just the past week.
Yeah.
J. Crew, Nordstrom. There are several others waiting in the wings for. And I didn't mean I meant Neiman.
Yeah, Nordstrom.
Nordstrom shut down a ton of stores recently, though.
16 stores they've decided to close permanently now. Yeah.
Permanently.
Yeah.
We've got a lot of companies that are on the brink. AMC Theaters was this close before they got some emergency financing. You can't play stocks. People have called us and said, hey, guys, it's way down. Why don't I buy Boeing? You got to get this. This is so important. Can Boeing go bankrupt?
Sure.
Can it? Not will it, because we don't know the will. And if you haven't figured out something by now, think about this for a minute. Did you in January of 2020 really believe we would be living in a world like the one we're living in today. I was talking to Mark Christopher at the station a little earlier, and he said, it's so weird. I haven't seen my coworkers in months.
Yeah, and
he said, I work alone. I don't see anybody.
And I mean, for those of us lucky to still have a job, and I count myself among that group, which I'm very thankful for. It's 1/6 of America that would like to work that's not working now, that is unemployed. I mean, the highest rate of unemployment since the Great Depression. So
yeah, I even saw an article today
world
that referred to it as the Greater Depression, possibly. And I'm thinking, oh well, that's not good.
No.
So here's the key to making it work, and this is the key. This has always been the key to making investing work. Nobody, you've got to believe me, I can show you the data, but we don't have time to go through it. It's out there. Nobody can consistently and accurately predict the future of stocks or bonds or any other security. It is literally impossible. So if it's impossible for the pros to do it, why do you think it's possible for you to do it?
Well,
grow up a little bit.
Yeah, even beyond picking individual stocks, picking the direction of the market. Because if you go to two well-known investing websites today, you get completely conflicting. Jeremy Siegel says, we will never again test the March lows. And then another expert on CNBC's Mr. Cashin, who's been around probably since the Great Depression, he says, "Oh well, hey, this market's going back down. The market's gone way up too fast." Nobody knows that. Nobody knows how to pick individual stocks, and all you have to do is read. I think Paul brought this up on our webinar this week. Herr Bessenbinder's study that found that only 4% of stocks.
Did you just call him Herr Bessenbinder?
I think he is, isn't he? I mean, I don't know.
He's Dr. Bessenbinder.
Oh, pardon me. All right, well, I'm lumping him in with the Germans, but because it sounds kind of German. But so a Dr. Bessenbinder study that found that only 4% of these stocks over time have really made money. The rest of them have either lost or have not produced more than T-bills, I believe is what his study found. So, again, being properly diversified, never more important. Not exactly what you just said, Don, not playing the market. Instead, having a plan has never been more. And this is another thing I talk to people about regularly the last few weeks on Zoom where we're doing all these meetings. People say, I'll put this off, I'll do this later. And I say, you know what, if you're retiring within 3 or 4 years, this is exactly the time to do it. Because you need to know exactly where you are and you need to know what you're trying to do moving forward with your money. So you're absolutely set for whatever comes next. I don't know if it's up, down, sideways, whichever direction, but you need to be prepared.
And I know how attractive it is to believe that you can time the market, for example, as Tom just mentioned. Here's an interesting fact. $1 invested in U.S. stocks at the end of the year 1900. Yeah. This is 120 years ago.
Ask Art Cash and he'll be able to tell you how he invested it.
Would be worth $51,000 today. $1, $51,000. Just in the total stock market.
However many stocks that was 120 years ago.
That's an annualized return of 11%. If you put the same dollar in treasuries in 1900, it would be worth $58.
Whoa, give those two numbers again. $1 to $58. I got that one.
1 to 58 in treasury bills.
Yeah.
1 to 51,000 in stocks.
And this is another mistake we've seen in the last 6 weeks. A lot of you took money out of stocks and put it in stable value because you didn't want to see it go down anymore. If you're going to be in stable value, if you're just going to have a savings account, that's fine. But you need to consider the fact that you're going to lose to inflation. Wow, you're really going to... I mean, that is a shocking number, $58.
Well, you want a more shocking number?
Yeah, give me more.
I got a better number for you. Let's assume for a moment that at the beginning of each year, you correctly predicted whether you should be in stocks or treasury bills.
Yeah.
You perfectly market timed each year, just every year. That's all you had to do was get it right once a year. You would now have $22.3 million.
Wow. All right. I'll take that.
So do you see why people want to market time?
Yeah.
But when we come back, I want to tell you why you can't do it. I'll show you some really interesting facts.
Tom and Don are talking real money.
Do you know what your investment risk tolerance is? Take our free no-obligation risk quiz at talkingrealmoney.com.
Your guides to a really great financial future. Tom and Don are talking real money.
855-935-8255 is our phone number. I'm Don, that's Tom, and you're you are, and we love you for being you. But you can't time the market. You may think you can time the market, and I can see $22 million from a dollar makes trying to time the market sound pretty darned attractive. But what if you tried to do it? How would you have done? Well, a gentleman by the name of Dr. Amit Goyal, who is a consultant to Avantis Investors out of Kansas City, part of the American Century family, he did a paper. And he used Robert Shiller, who won the Nobel Prize in 2013. He used his CAPE ratio, which is the cyclically adjusted price to earnings ratio. It's what a lot of people on Wall Street use to determine whether the market is under or overvalued. So it's used as a timing mechanism.
The CAPE ratio for me is what I wear when I'm feeling really great about myself and I think I can conquer something. So
that and the really tight tights that really make
I'm not
you
allowed,
look silly.
As you know, to wear those without sufficient covering.
If the CAPE ratio is low, that indicates that the market is underpriced. If the CAPE ratio is high, that supposedly indicates that the market is overpriced. So what if every year, when the CAPE was low, you were 100% in stocks?
The CAPE low, you're putting money in stocks. Makes sense,
if
right?
If the CAPE was low the previous year, right, you ended the year, low CAPE, prices are undervalued, you're 100% in stocks.
Yep.
If the CAPE is right in the middle, you're 100% in treasury bills. And if the CAPE is high, where stocks are overpriced, you buy put options, which are betting that the market is going to go down.
Of course.
Okay?
Makes sense.
You did that from 1900 to 2018. Now, remember, just buying and holding the market during that period returned 11.3% per year.
All stocks.
All stocks the whole time, holding them the whole time. But let's say you went into puts when the market was really high. After the market was really high, you were in treasuries when it was in the middle, and you were 100% in stocks when stocks were really cheap, supposedly, according to the CAPE ratio. This is kind of a
trend following.
It is. It's trend following.
Price.
Right.
Yeah.
Your average annual return from 1/1/1900 to 12/31/18 would have been 5.2%.
So you missed out on about half of what the market provided just by buying and holding.
Over half. By trying to time the market.
What was you obviously the volatility you would think would be less because you're out of stocks sometimes, right?
Of course it would be.
It's less risk in a way.
It's less risk, but it's less return. And you can get less risk and reduce volatility without trying to time the market.
Yeah,
and that's by creating a well-diversified portfolio, because when you time the market, you have all kinds of expenses that are not factored into this. You've got the trading expenses in and out of all these vehicles. You've got the taxes. Because every time you sell out of your stocks and you have a gain, you got taxes on that gain. So this market timing, it can't work. It cannot work, because for market timing to work, please listen very, very carefully. You can't just guess right. You have to be right.
Twice.
Right. When you buy, when you sell.
And you got to get out, you get out in the middle of March after everything blows up and the market's down considerably, as it did very quickly. And then you buy, in a trend following system like that, you're going to be buying back in after the stocks have rebounded again. Yeah, that's the struggle.
Well, and that was the thing. I brought this up on yesterday's daily podcast. The current market, bottomed out on March 23rd, the S&P 500. Bottomed out on March 23rd. Think back, because it's recent enough that you remember your mindset, I hope.
Oh, boy, do I
ever. On March 23rd, 2020. I was
hiding under my sheets for about a week, right. You know that. So
March 23rd, 2020, were you sitting there thinking, oh, this is it, it's over, I'm getting in?
Yeah, no way. No way. I tell you why I know that's not true, because you were sending us messages. The line to make retirement changes at Boeing you couldn't get through to, and many of our clients were calling us saying, is it time to sell stock? No, it is not time. to sell bonds.
Yeah.
Not
Everybody
stocks.
wanted to sell. Everybody wanted to sell stocks at that point. Not buy them, but that would have been the perfect time to buy in hindsight.
Tom and Don are talking real money.
Do you know what your investment risk tolerance is? Take our free no-obligation risk quiz at talkingrealmoney.com.
Reality radio for a really great future. We're talking real money.
Hi, Don here, Tom over there. This is Talking Real Money, the most important topic discussed on the radio. Don't know if it's the most important show, but it is the most important topic, really. 855-935-TALK is our phone number. That's 855-935-8255. It's free and easy. You can call right now. We've got lines open. Lots of them. All of them. 100% open. Or you can send a note to Don at Vestory, VESTORY.com, and I'll read it on the air.
Or you can go buy Pompeii wood-fired pizza, order online.
Oh, yeah,
and
where
get
is
your
that
pizza.
again? What's that corner?
It's up in Bothell at the... I missaid this the other day. I said my wife's working the street corner. Came out wrong. Somebody said, "Wow, times have gotten tough there." I guess huh?
She is younger.
Yeah, let's not do that. It's the corner of Highway 524.
You couldn't make any money working a street corner, but maybe she
really
could.
slow. It's Highway 524, better known as Maltby Road and York. It's at a church there. You can't miss it. So if you're in Bothell...
So what you do is you go to PompeiiWoodFiredPizza.com.
Yeah, that's it.
And then you order your pizza on there.
Yeah, you can drive up and order when you're there because it takes them 5 minutes.
And I'm going to be there at X amount of time.
And they're all ready for you. Yeah, it's pretty slick.
I just think that's very cool.
Or you can get... Or they do it just from the home. You hit print and it prints it out. It's not as warm, it's not as tasty, but it's quicker.
It's a strange new world we live in. You know, I live in Florida, right?
That's a heck of an internet connection for you. Yes, I agree.
But you know, it's funny. Yesterday, Friday, our homeowners association board decided we need to be normal, so they're reopening the pools here.
All right.
And they decided, I don't know where they got this number. Nobody's using science. I just don't. They said, let's reopen the pools at 50% capacity.
Just because it sounds good, it's half as many people that used to be there.
I did the math. If you put 50% capacity and you put everybody in the pool, they would be 3 feet apart.
So you're like using real science. Like that's too close then.
Yeah, I did the math.
Can I make a suggestion? You could do it 25%?
That's what I said.
I think I got the math right on that. I may be wrong, by the way.
25%?
You know, math can get you in trouble a lot of times because there was a case recently. You remember when oil prices went just upside down, inside out?
You wanted to pick up a contract.
I wanted to, because until they
negative $37 a barrel,
would have to go into the swamp there and be waiting for somebody to come and actually take the oil. I was all set to do that because it looked so easy. You're going to make a lot of money. Buying something that they want to pay you to take, right?
Right. Well, there was a trader, a guy who used to trade stocks, which is dumb enough, but he was so tempted by the price of oil that he bought a contract when it was the May contract.
And you explain what that means. You bought the May contract.
You're buying the obligation. You're buying an obligation to buy oil at a certain date in May.
At a certain price.
At a certain price.
Yeah. Okay.
So he bought the contract saying, I'll pay $3.30 a barrel.
Yeah.
He thought, that's the best deal ever.
Can't
And then later that day, it went down to 50 cents.
That's even better.
Oh, I got to buy some more. So he did.
Yeah.
And then it went down to a penny. And he goes, I'm buying 212 contracts at a penny each. That
seems reasonable.
Right. It seemed like he had gotten such a great deal. Well, it turns out his brokerage firm, a company called Interactive Brokers, had a system that didn't allow anything to trade for negative dollars.
They didn't have a system that was set up to have a negative in front of the
They
amount.
just didn't. The system couldn't. So the price stopped at a penny. It just stopped there.
Yeah. And
even though he's watching his screen and it's at a penny, it's at a penny, it's at a penny. while in the background,
Oops.
in real life,
Yeah.
it dropped to negative 37.63 a barrel.
So he was paying $37.63 instead
he
of
had to
1
pay
cent.
somebody.
Yeah.
He had to know. He bought. He was going to have to buy oil at a cent. Well, now he'd have to pay somebody else.
Oh, that's right.
$37.63.
To take it, yeah.
He went from a few $1,000s in an obligation to owing $9 million in one day.
1 day. Wow. That's-
Part of a day.
So that's the
And he
easy
didn't
money
even know.
made in simple trades that are so. I'm glad I didn't do this, by the way.
Yeah, I'm really glad you didn't do that. Turns out the firm, because their system stinks, is going to pay him back. But for
good.
a while, he lost $9 million.
Tom and Don are talking real money.
If you're sick of your self-interested financial advisor and are looking for a 100% fiduciary low-fee investment advisor, call my firm Vestory at 800-386-3004 or visit us at vestory.com.
For your real life and real future, Tom and Don are talking real money.
I'm Don. He's Tom. This is Talking Real Money. Give us a call. 855-935-8255. 855-935-TALK. Talk, as in talking real money. Bob, thanks for the call. Welcome to the show.
Hello, Bob.
Well, good afternoon, guys.
Hey.
Hey, Don, Tom, I've got a question for you. My wife and I bought a piece of property in 2007 that we haven't done anything with, except maybe some minor clearing and this and that. But my question is about capital gains. We're getting ready to build. We're going to close on the loan on the 12th for the construction loan. Are we going to, even though we haven't built on that house, but we've owned that or built on that property, we've owned that, are we going to get hit with capital gains when we sell the house we have now? We want to sell and pay down the construction loan as far as we can.
You get your one.
Wait.
You get no. He's talking about selling the home you're in today.
You're
correct?
selling the home you currently live in, correct?
We will sell it once
Yeah.
construction's just about completed. That's our plan.
Yeah, you get the one-time exemption. I forget the dollar amount, Donna. Is it $500,000 or it's? We'll look it
Yeah,
up. But you
it's
get
at
the
least
one-time sort of life. You get the one in the lifetime exemption for selling.
Okay. Well, there's some positive news.
Yeah, so you won't be paying. You shouldn't be. Don's gonna look at the amount.
Wait. He can get he can roll his capital gain if he builds another house. He can just roll it ahead and then take his lifetime on that house down the road.
That I'm not as familiar with.
You can sell your primary residence. It's allowed. I'm sorry. It's once every 2 years. So he can deduct up. He can take. It's $500,000.
That's what it was. Okay, I had the number right.
For a married couple, and it's allowed once every 2 years.
In other words, you could do it and then you could do it again. So
Do it
I
again in
mean,
2 years.
so let's just say, for example, how much is the home you live in worth today?
Well, I'm thinking that it's worth $400,000. I think after what we owe on it, we're going to take $200 out of it.
There you go. I mean, so you're going to have no capital gains tax at all, nothing.
And then you stay in the new house for 2 years. You won't have any on that one either.
Yeah. Where's the new one? Where are you building?
In Gold Bar.
Oh, beautiful out there. I love it. I love
That's
Gold
right
Bar.
on the river. It's been a real working with the county. It's taken 18 months to get to this point, as you can only imagine.
No, I can't. And do you have people ready to go to work?
Yes, we do.
All right, even better, because I think that's going to be another challenge. Yeah.
I do love Gold Bar, too. That would be an area. If I was to live in the
beautiful.
Seattle area, I'd live up in Gold Bar.
River runs right through there. It's and you're close to the mountains, and and you can still get into town if you need your supplies.
That's up 2, right?
Yeah, it is. Yeah.
Oh, guys, I've got a beautiful home on the river coming available for sale in about 5 months.
Oh, well, Don needs another property because he only has like 3 places to live right now.
Yeah,
so
no, I
he'd
have
be
2.
perfect.
I only have 2. I need a third.
Well,
You're
no,
right.
you've got the silver bullet too. That's 3.
Oh, the silver bullet. Yeah,
He's got 3, and even around 4 would be good, Bob. So Don will talk to you off the air about that purchase too. So that's seller financed, right?
Valuable. We'll certainly consider that in the negotiation.
All right, we'll work something out.
Take that into consideration.
Thanks, Bob. Thanks,
Exactly.
Tom.
Exactly.
Thanks for all your help, guys. I really appreciate it. Hey, our number is 855-935-TALK, 855-935-8255. Heck, Walt Disney's old Palm Springs house is on the market right now.
No, that we could.
So I might as well get that.
Yeah. With your Disney
All right,
connections, I'm sure you can get a major discount there.
It's only $1 million for his Palm
Wow.
Springs house.
Wow.
It's a dump. It's a little
Guessing.
ranch-style tract house that's...
But you can say, come on over to
it
Disney's
used to be
place
Walt
for
Disney's.
dinner.
Come over to Disney's place. 855-935-TALK. And Alan, welcome to Talking Real Money.
Hi, good afternoon. I got a question about single premium deferred annuities. My financial advisor called me, said he wanted to replace a maturing CD with a 2% 3-year single premium deferred annuity. And it's just basically a CD, he says. It doesn't pay anything out per month or per year or anything. It just you wait till 3 years, and then you can cash it out. What do you think about that as a replacement for the safe money?
I can tell you why he loves it. I can tell you
I
why
know
he
why
loves
he
it.
loves it. But from
Huge
my
commission.
standpoint, it's paying 2% right now. And there aren't any CDs paying 2% for 3 years around anywhere right now.
Yeah. But here's the question I have for you. What is the advantage to you in getting that?
It's a safe money. It's 2%. It replaces my current CD. And
let's think about that for a minute, though. Who is backing that security? Who is ensuring the safe?
Insurance company.
Wait. Right, an insurance company. Now let's assume for a minute that something happens to the economy, that we fall into a depression, as some I have predicted. I'm not saying it's going to happen. Let's just, for the sake of argument, assume that. What happens to the insurance company if they're not getting enough in premiums to continue to pay things out, and the assets they own, which are usually risky assets, which is why they can pay that much, they get into trouble? What happens then?
Well, they'll probably get bailed out like AIG did 10, 12 years ago.
That was
like that.
No, I think that's a very good point. But Executive Life in California years before that did not get bailed out, and many of its annuity holders are still getting paid off today. I think you guys are way too far. I think you need to step back and look at the big picture first to say, is this like for your safe money? Is this for the bond type part of your portfolio? I mean, what is the purpose of owning either the CD or the deferred annuity?
It's the safe money, is the bond portfolio of my portfolio.
If the bond portfolio, I find that fascinating. So what kind of bonds are you in that? In other words, you could just go own we could own the Vanguard Total Bond, which we recommend, but you could own the Vanguard as a very fine federal bond that has a little bit of long, mostly intermediate and a sizable amount of short that's probably yielding over 2, and it's going to be cheaper, and your money's going to be available every day, and it's guaranteed by that institution that, well, I think it's very unlikely to fail. They're called the federal government, because if it does, then there's whole other problems to consider. I mean, that's how I would be looking at that, sort of, why do you need this as part of your plan? And how old are you, Alan?
66.
66. And so this is money that at some point you may need to pay for your retirement, I take it.
Yeah, eventually, but I don't really need it right now. It's a 3-year CD or a 3-year single premium deferred annuity.
And I just looked at bank rate. You can get a 2-year CD for just a hair under 2, but I didn't know it was 3. I thought you said 2-year. I wouldn't do it for the reasons I just mentioned. I see no reason for it as part of an overall plan. I guess that's how I'd put it.
And my reason is
exactly what I told him. I've been listening to you guys for decades, or listening to Tom for decades, and that's exactly what I told him. That I didn't trust the insurance company being around.
It's not even that. Again, I don't see why you need to tie up your money in that product, pay more than you would in just a bond. Are U.S. government bonds volatile to some extent? Sure, but not that much. And again, that's why I was trying to find out how soon until you needed the money. Vanguard's done some very fine studies looking at even in periods of time when those type of bonds go down, they come back very, very quickly. So I would just use a bond fund, low expense, no commission, and liquidity anytime you needed it.
Or the other option is always the whole ladder of CD things. You're not going to get the best rate today, but if rates sneak up, a 1 year maturing, you go out to 3, you keep doing that, you could do very well.
Tom and Don are talking real money.
Just about everything you need to know about money can be found at our website, talkingrealmoney.com.
Your guides to a really great financial future. Tom and Don are talking real money.
I just did a CD ladder right now, and you could get an average return on a 3-year CD ladder of 1.7, which means every year you've got one CD coming due in case of emergency. And if you don't need it, then you roll it right back out to the new rate at that longer maturity, which I think is a much better, much more flexible way to do it anyway. And safer. If you need help managing money, we do that at Vestory, one of the fastest growing firms of its kind. And you can do it by just going to vestory.com.
We hope you realize that the information provided on Talking Real Money is for educational and hopefully enjoyable purposes only.
Providing personalized financial planning or investing advice takes time, so please consult with a really good fee-only fiduciary investment, tax, or legal advisor. We know a good one. Investing must always involve risk. In other words, you can and probably will lose money at times.
Also, as much as you want it, no one can accurately and consistently predict the future.
So past performance doesn't tell you a darn thing about what the future will bring.
Unlike many other programs that say something similar, Talking Real Money is not trying to get you to buy or sell any financial products or securities.
Instead, the program is provided as a public service by Vestory, a fee-only registered investment advisor.
Thanks for listening, and please visit talkingrealmoney.com for more information and disclosures.
That's a wrap.
advise that the information provided on Talking Real Money is for educational and hopefully enjoyable purposes only.
Providing personalized financial planning or investing advice takes time, so please consult with a really good fee-only fiduciary investment, tax, or legal advisor. We know a good one. Investing must always involve risk. In other words, you can and probably will lose money at times.
Also, as much as you want it, no one can accurately, consistently predict the future.
So past performance doesn't tell you a darn thing about what the future will bring.
Unlike many other programs that say something similar, Talking Real Money is not trying to get you to buy or sell any financial products or securities.
Instead, the program is provided as a public service by Vestry, a fee-only registered investment advisor.
Thanks for listening, and please visit TalkingRealMoney.com for more information and disclosures.
That's a wrap.